Good morning, Daniel.
Morning, Dan.
What do we feel like chatting about today?
Today I feel like chatting about three things. One, how to actually measure portfolio performance. Two, the various strategies behind portfolio withdrawal. And then three, I thought we'd finish things out with how we think the financial planning profession has evolved and maybe what we think things will look like in a couple decades here.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, measuring performance. Time weighted return. Easy enough.
I think it's an interesting one, because I was thinking about this the other day. I have a lot of friends who, they subscribe to like the low cost ETF model, which I'm all for. But one friend in particular who definitely is not listening is a big S&P guy, and that's pretty much it. And he tells me the other day, he's like, "Oh no, I put like 50 I started doing, some of the things you tell me to do, right? I put it in international, I put it small mid cap, right? All these like these other things to diversify." He's like, "But now like, and he's like, "Yeah, but like the last month it didn't beat the S&P sort of thing." And I started to have the conversation with him of like, okay, well, like, and I think I don't even need to get into the conversation, but I think we can answer some of the questions and talk about some of the things we talked about. So, like, for example, right, what is the actual timeline I should be using for comparisons of beating a return or underperforming a return? If I'm comparing to a benchmark in general, what sort of benchmarks should I be comparing to? If I'm not fully in the S&P, why should I be using just the S&P? And really just dive into some of those things. So I think first and foremost, like, how does somebody measure performance? Like, we have, software and the tools readily available to us, but let's say somebody's investing their own money and they're looking for quote unquote benchmarks. Like, how do they actually go about finding benchmarks and using them as a metric to compare to?
Yeah, I think this is one of the challenges of a lot of like major brokerage platforms. Like if you're on Fidelity or Schwab or that sort of thing, like they'll tell you you started with X and now you have Y. Like they'll tell you the cost basis differential between your interest and your principal, but they won't give you like a time weighted return or an IRR or any of the other common mathematical models of calculating return. You can hand jam it in Excel, or you could probably even like dump your portfolio into Claude, and Claude could probably kick out a time weighted return calculation that was approximately correct. But your question here is then like how do you compare that to benchmarks? I think first and foremost, almost no investor should be using a single benchmark for their portfolio. Like your friend here is saying, like, oh, the S&P 500 index, like I was investing in that, and you told me to diversify, and now I'm not beating it. Like, yeah, you're either gonna not beat it or you're gonna crush it, and it's gonna depend on how well that index is doing relative to all the other indexes. Like it's sort of this weird thing of being like, well, what's that expression, right? If you measure a fish by its ability to climb a tree, the fish is gonna think it's dumb its whole life. Not that fish are that bright anyway, but it's sort of the same thing. Like you can't use any unique specific index to measure against a diversified portfolio. Now, if you just want to go all in on US domestic, large cap, concentrated, sure, S&P 500 fund, it's going to trail by essentially the cost of the fund, 1, 2, 3 basis points, and it's going to do about as well as the index, and that's all it's going to happen. And that is fine until that index or until that asset class has a problem, right? So, like you look at 2025, the S&P wasn't the best index by a mile. International crushed it last year. You go back to the 2000s, and if you were using the S&P as your benchmark for a good portfolio, you'd look like a moron, right? Because international, small cap, mid cap, emerging markets crushed the aughts. So there's just a basic logical fallacy here thing, which is like, well, I'm going to pick the best index of the last decade, right? There's that joke about like VU and chill, buy the VOO ETF and just do nothing else. And like, yeah, if you buy VU, you'll get the S&P return, but that relies on a predisposition or presupposition that US domestic large cap is going to be the investment that you want and need, and that is going to fuel your life's goals and ambitions. And I think any logical investor can just ask the question, do I need to be more diversified than a single asset class to be smart about investing? And I think almost anybody with two brain cells to rub together would go, yeah, probably.
Right, so what you're saying is more or less something along the lines of this. I'm going to simplify it just for the example, but like, I'm a third large cap, third mid cap, third small cap. Essentially, I should be taking three different benchmarks from large, mid, and small cap, and then weighting all of them relative to the portfolio, and then what the average of that is should, in theory, kind of be what I'm using as a comparison.
I think more importantly, you should be comparing your large cap to a large cap index, your mid cap to a mid cap index, your small cap to a small cap index, and you should have a blended benchmark that you're comparing to. Recognizing then that if you're buying index funds, spoilers, you will never beat your blended index, right? Because your blended index is perfect. It has no trading friction, it has no trading costs, it has no bid ask spreads, it has no inefficiencies, it has no market timing problems. It's flawless. And so if you buy the index funds that track those, they'll do almost as good, but you will never beat the index. And that's sort of the thing here is, indexing, taking a diversified passive approach is acknowledging that you are never going to beat the market. You're only going to buy assets that trail the market by the tightest margin possible.
So does that mean, I know we subscribe to, a fairly similar model ourselves. Does that mean technically we are underperforming? I'm wording things, in a tricky way intentionally, but like, does that technically mean we're underperforming?
It's interesting because we have, depending on the benchmark we look at, so like let's say if we look at like our aggressive portfolio, if we benchmark to a blended portfolio, yeah, we essentially underperform our blended benchmark by the margin of our cost and the cost of the product. So, our wealth management fee or financial planning fee is based on 0.5%. That means we essentially are trailing our benchmarks by about 0.5% and like, 1 to 3 basis points more, depending on the exact specific fund and asset class and so on. The trick there is that is a known cost, and I think you've heard me talk about fee arguments and debates all the time. The laziest view of fee discussions or cost discussions is, well, I would get X performance, so then why would I ever agree to get X performance minus a cost? Well, yeah, and the basic answer here is because you're getting something valuable for that cost. So, to the direct part of your question, yeah, we're underperforming. Right, we're underperforming the blended benchmark. But there have been years, for example, where our portfolios beat the S&P, not because we were trying to beat the S&P, but because our portfolios have a diversified base of mid cap, small cap, emerging markets, international, conservative portfolios will have, bonds and so on. And sometimes the S&P is not the winning asset class. Right. So on a blended base, we never beat our benchmark, and we never will. On a objective benchmark base, some years the S&P is going to beat us, some years we're going to beat the S&P, some years the MSCI EAFE is going to beat us on the international side, sometimes we're going to beat it. Sometimes it's going to be a bad stock year and a good bond year, and the bond market is going to crush it. Like, it just depends on what we're trying to measure. But that's, again, comes back to this thing of, there's this expression which is, being diversified means always having to say you're sorry. Because if you're actually properly diversified, you're going to have some winners and you're going to have some losers in your portfolio all the time. The trick is they're not always the same winners and they're not always the same losers.
Yeah, that's a really good point. And I think that's a good way to explain it in our philosophy and how we do things. But let's say somebody doesn't, follow exactly our model, so the underperformance things may be a little bit different for them. I guess, like, how often should they be making comparisons to benchmarks and like checking in to see, oh, I'm underperforming for the third straight week or third straight quarter or third straight year? Like, how often do you think they should be checking in on that?
If you're thinking in those terms, I think you are missing the point. I think there's two benchmarks that matter. One we've already sort of touched on, which is like the fund by fund benchmark. Like, you should reasonably, at least once a year, look at your large cap fund and be like, hey, is my large cap fund at least like mirroring the S&P? Yes or no, right? Is my small cap fund mirroring the, S&P 600 or the Russell 1000, whatever I picked? Yes or no, right? Like, there's what's called tracking error in these index funds, which is like, okay, again, the fund isn't perfect compared to the index. So how closely does it track? I think that's something you want to look at and you want to compare and you want to consider. On the other side of that, when you then get into the like, okay, but how much money am I making? Am I having a 8% year consistently, or am I getting a 6% year consistently? But I wanted 8%. Should I do something about it? I think the more important benchmark there is not a market benchmark. It's not a product quality benchmark. It's an objectives benchmark. Am I on track mathematically to attain the goals that I've set out for myself, right? And that's a big function of what financial planning is. We've done the math, we know how much we need to save to retire, and when we get to retirement, we know how much we need to live on, but those rely on presuppositions of inflation and expenses and income and rates of return. And we do all the math, and year by year, you might be ahead of the curve, and year by year, you might be behind the curve. And so there's a balance there where that's the more important part of benchmarking is, are my investments, is my portfolio lining up to accomplish my goals effectively? Or am I behind the curve in terms of return or in terms of, risk reward or savings rate where I need to do some work to make up the difference, or I need to adjust my expectations and my goals.
And do you think that conversation, if the real benchmark is, the probability of us achieving our goals given what we're currently doing from an investment standpoint, is that also, you think, a yearly exercise?
I think it's ideally a yearly exercise. There's this observation that I really dislike, but it's probably true, and that's probably why I dislike it so much, that the average person spends more time planning their annual vacation than they ever spend planning their retirement. And so it's that thing where, like, I'm a financial planner, so do I think you should do financial planning every year? Yeah, you definitely should. You should definitely be comparing where I am to where I'm going and whether my savings and my investments and my insurance and everything else that's part of my financial life are lining up to accomplish those goals. I think that's a very smart thing to do. Do I think people do it and will do it? Probably not. And it's just the honest truth of it. But do I think it's important? Absolutely.
No, I think that's good. I think that kind of helps clarify some things there. So, the various strategies behind portfolio withdrawal, I'm sure this one might put some folks to sleep. So, so apologies in advance. Maybe I should have made it the third topic so someone could tune out early. But I wanted to just talk about it because I think it's interesting. There's various schools of thought and strategies behind someone has a sum of money. How do I go about now turning that asset into income that I can rely upon without running the risk of actually running out by the time I pass away, unless that's my full intention? So there's certain things like Bill Bengen and the 4% rule, which has certain, nuance and intricacies and concepts of itself. There's also things like retirement guardrails, etc. So I wanted to just talk about them for a couple moments here. I think first and foremost, the one that most people who are interested in this topic know of is just the 4% rule, which, to be very high level and lack the nuance in explaining, is really just like you have a portfolio, you can withdraw 4% from it, adjusted for inflation every single year, depending on the allocation and the actual investment. I think first and foremost, we've talked about this one before, but in terms of where it sits from your favorite strategy to your least favorite strategy, I guess, what's your take there?
I mean, first and foremost, I dislike the title of it, the 4% rule, because it's not a rule. It has never, and to be clear, Bill Bengen has never come out there and said this is the rule you should follow. Like you can and should distribute 4% and you'll be fine, right? And he's updated it over decades where like sometimes it's been like the 3.5% rule, sometimes it's been like the 5% rule, but everybody just like hones in on the 4% rule and like that's what sticks in their brain. That's the mnemonic that won't leave us alone. So as far as like a method for distributions or strategy, I don't like it at all. And I don't like it because Bill himself has come out over and over again and shown that sometimes it's more, sometimes it's less, because he keeps updating it with new data, which is great. Like that's what he should do. But like all rules of thumb, it's an imperfect measurement stick that a lot of people use as good enough. And as a professional, my question here is, do you want to bet your life on good enough, right? Would you go bungee jumping with good enough equipment? Would you go skydiving with good enough equipment? Would you go scuba diving with good enough air tanks? It's probably going to work out. You'll probably be okay. How certain are you about that probability? And are you willing to bet your life on it? That's sort of the question that I ask as a professional is, do you want to take this paper, this number that's changed over and over and over again over time and been reduced down to a meme of a phrase, right? The 4% rule, and bet your entire life savings on it and the welfare of your family, your spouse, your children, your grandchildren on that. I wouldn't, but that's just me.
I'm not disagreeing with you, and yeah, he has updated. I think right now it's at 4.7 from his most recent update to his paper, and he also changes the allocation in the actual investment portfolio. So, for whatever that's worth, I think that's part of the reason it's increased because he's more diversified into mid and small cap now. So, I just want to touch upon some others. Like retirement guardrails is one I find pretty fascinating. So starting with like the Guyton and Klinger sort of school of thought and model, which I'm also going to oversimplify. Feel free to add some more detail here. But essentially, the way I understand it is instead of a static 4%, instead what you do is if the market increases or the return on your assets increases by a certain amount, it allows you to now withdraw a slightly higher percentage or dollar amount from your portfolio. And then when the market declines a certain amount, I believe it's 20% on both ends, you should decrease the amount you withdraw from your portfolio. Essentially saying that when markets are great, you can take more money. When markets are poor, you take less money. Benefit there being the bands, right? So you know as a investor, okay, well, if my portfolio goes from 1 million to 800,000, I'm going to spend $5,000 less a year. That is a certainty. I know it, and that's going to work for my plan. Is that kind of how, oversimplified, how the retirement guardrails strategy sort of works there?
Yeah, I mean, you've hit the nail on the head here as far as just the basic thing of like, if we're up 20%, we can spend more. If we're down 20%, we'll spend less. And we just sort of are kind of benchmarking that over and over again. In practice, it shows up very choppy. Like if you look at historic back tests of that methodology, your income level is constantly jittering up and down because the market tends to move in 1 to 2 year periods fairly substantially, right? Like it's very normal for us to see an individual year where the market's up 25% and the next individual year the market is down 15, 20%. So it creates this thing where when you look at the back test lines, an income level might start at like $10,000 a month, and then 4 months later it's up to 10,500, and then a year later it's suddenly down to 8,000. It creates this like very choppy retirement experience, which I do not think is very effective. I respect the idea behind it. But there's also another strategy that often gets paired with it, which I think is used to smooth over the Guyton Klinger model's sort of flaws.
Yeah, well, let's put that on hold and we could talk about that in a second. But I want, before I close that one out, I think it's interesting because, like, I could think you could make an argument for both sides. Like, I think there are people who would be annoyed, right? Like, receiving an email from us and being like, hey, your portfolio dropped to the amount. We now have to reduce your spending. So we're going to cut, your monthly distribution by X. But I do think there are probably other people who do feel more comfortable with that certainty of knowing, like, I think there's some people that, say they're taking $50,000 a year from their investment account, right? And the market is simultaneously declining in value, right? I feel like there's a certain amount of people who would really be discouraged and uncomfortable saying, I'm going to continue taking, four or five, $6,000 a month, whatever the amount is, while simultaneously watching this account deplete, and just drop in value. But if they know, okay, this is part of the plan, like I know at this point I now reduce spending and that ensures, that I won't run out of money, that they probably feel a little bit more comfortable with that. Is that kind of fair?
It's more comfortable. I guess my challenge as I look at this is, for example, I always like to look at the industry as a decent bellwether for whether an idea actually has legs under it. Which is to say, there are certain participants in the industry who do not tell you why they will or won't do something. You just see them do it or you see them not do it. The thing that's always stuck out to me about Guyton Klinger as a way of managing retirement income and preserving assets for the long term is there are no annuity products built around it. And that's sort of what like stands out to me because it's like, okay, like there's a clear methodology here, there's a clear style to this, and if it can produce decent or reliable income and the math supposedly works really well, you would expect to see an insurance company package that up, assign themselves a 50% margin on it and essentially automate that for people as some version of like a fixed indexed annuity or a variable annuity with a like a Guyton Klinger guardrails like rider attached to it or something like that. That product doesn't exist. And Guyton Klinger is not a new idea. Klinger's been around for quite a while. So it's a thing where I think on the back end, part of what gives me some skepticism around it is the fact that the actuaries in the companies that love to make money based on retirement guarantees don't seem sold on it. And it's just something where I look at it and go, like, the paper is the paper, and there are some sort of vocal advocates for it in the industry, but I think the applied practice of it, the math maybe just doesn't shake out efficiently enough or effectively enough to actually produce a stable result. Because again, if it worked as well as it's supposed to work, I do think you would see the insurance industry snapping it up and offering it to the public.
Yeah, I never thought about comparing it to, what the institutional market implements, but that's a good idea. So what was the method you were referring to that was kind of like an improvement upon the Guyton Klinger?
Well, so I think you misunderstood that. There is a method that I think improves upon the notion of how the Guyton Klinger works, but actually what I was talking about is there are certain people in the marketplace who like have built a brand around offering their clients a Guyton Klinger style of retirement income, but also who then pair that with this just enormous safety net. Like they'll say, "Hey, we're going to do Guyton Klinger for you, and we're going to do a 65% or even 100% equity portfolio because the Guyton Klinger works better the more equity you have in it." But to make sure that you don't ever have any interruptions from that decrease in spending strategy, we'd also like you to have, 3, 4, 5 years of cash lying around. And then I look at it and I go like, hold on, like this whole thing is supposed to be this stable mechanism that keeps you from ever running out of money in retirement. And part of the secret to that working is the fact that Guyton Klinger will just like keep reducing your spending rate over and over and over again. It's, it's like trying to divide something by, let's say, like 1.01. Like you'll never hit zero. You'll just keep getting to like smaller and smaller fractions. So, Guyton Klinger will at its extremes cap out at you'll never have less than a penny as a sort of style of retirement income. But on the other side of that, like part of what a lot of people use to make Guyton Klinger work in practice is they just say, well, just in case the market does tank, why don't we just give you so much money that you could outlast the longest market downturn that's ever occurred? Okay, well then really the Guyton Klinger is not actually providing the retirement security. The giant cash moat is providing the retirement security. So again, I just find myself looking at it with this great deal of skepticism because yeah, the math does work. And also, I'm not sure that it actually is doing what it's supposed to. I think we have a correlation causation problem here.
It's interesting having the 3 to 5 years in cash and then pairing that with what we're talking about with the retirement guardrails. Do you think, like, get rid of the retirement guardrails thing for a second? Do you think there's merit to just holding the 3 to 5 years of cash and then just investing the remainder of the portfolio as you see fit?
I think it sort of gets into the same categories like whether you treat Social Security as a TIPS portfolio, an inflation adjusting treasuries portfolio, or whether you account for pensions from like a school district or para or something as part of your portfolio or not. Because the same people who will say, oh, you keep 3 to 5 years in cash will then, without batting an eye, say, and also we want to be conservative with your portfolios. We're going to be, 65-35 stock fixed income. And it's like, okay, but if I added the cash back into that ratio, your portfolio would be like 40% stock and 60% fixed income and cash. So again, I just look at that and I go, okay, we are sort of double dipping on security things here. And in total fairness, right? I think anybody in retirement would like to be fairly confident they're not going to run out of money. Like that's the entire annuity business summed up is we will guarantee you don't run out of money. But on the other side of that, I think there's this sort of, having it both ways thing where we're going to say like, oh, we're going to give you super high income. P.S. We're going to give you super high income only based on a certain portion of your assets. We're going to say you have the super high distribution rate that's better than the 4% rule, as long as you ignore all these other assets and sources of income.
Yeah, that's a good point too. Like adding the cash back into it and how it changes the calculus there. Like you probably can't afford like be super conservative in the portfolio plus do the cash buffer on the side.
Just to come back to your question a little bit, the same thing that I think about here in terms of like, should you have 3 to 5 years of cash? Maybe, but you could also just have a home equity collateralized mortgage and use that line of credit to float over any major downturns in the same way, and then make a decision later about whether you want to pay that debt off or whether you just want to go ahead and bank it and keep spending your money as you want without selling stuff at a discount. Like there's multiple ways to hedge material market downturn risks. But I think at the same time that people say something like these, Guyton Klinger guardrails work so well, they're also advocating these incredibly conservative other strategies in tandem with it that effectively mean that Guyton Klinger is not going to be the thing that determines whether your retirement works or doesn't work.
I was reading about adjusting it from like a how the portfolio is doing to risk based. So using a Monte Carlo probability of success to determine when you change the withdrawal rates. So right, the Monte Carlo being, 1,000 scenarios showing you how many of those scenarios you run the risk of over or underspending in retirement, and it spits out a percentage, right? And in theory, the median being 50% means you have just as likely a chance of overspending throughout your lifetime as you do of underspending and running out of money. And I think they use something like 20 when it hits 20%, meaning there's a high probability of success or low probability of success and a high probability you run out of money, you adjust the spending, and conversely when the probability gets too high, you adjust the spending. And I've read that apparently that reduces the amount of times you have to reduce spending in retirement and still keeps the probability that you actually have money high. Do you have any thoughts, or have you thought about that one at all, as opposed to just the way that it's kind of presented with Guyton and Klinger?
It's doing the same thing, right? It's setting a high watermark and a low watermark and saying we'll adjust spending when we hit it. We're just exchanging a dollar-based watermark for a probability of success-based watermark. But in the same back testing sense, the back tests are substantially smoother. And they're substantially smoother essentially because the guardrails are substantially wider in practice, right? Getting to 100% probability of success, meaning you're going to increase your spending, is very hard to do. It means your portfolio really has to have crushed it above and beyond your needs and your expenses. and vice versa. To decrease your spending means you have to have really lost quite a bit relative to your aggregate requirement to actually fund your retirement plan. So I do think it's one of those things where it accomplishes one thing well and it increases a different risk in turn. It accomplishes not having to change your spending every couple of months or every couple of years. And also, it does expose you to a much lower probability of raises and a much greater probability of failure if you run down to those extremes. Like I think hitting a Guyton Klinger bottom guardrail and reducing your spending happening more frequently means you're much more likely to reduce your spending on a regular basis. In turn, getting a Monte Carlo probability of success down to 20% or 25%, you've got to go down quite a bit, or you have to increase your spending quite substantially. And either of those are going to be events then where, like, not only do you have to make that adjustment, like, you really need to make that adjustment, or you are going to go off the edge. So I think it's something where I like it from an experience standpoint because, again, it's going to be a lot easier and a lot more comfortable on the retiree. At the same time, I do think it's a riskier approach because it is using math reasonably to smooth over a lot of the rougher edges that a more conservative approach creates.
So it sounds like we could probably poke holes in all of these strategies we've kind of talked about thus far. Like, I'm curious, as we've now walked through a couple of them, like, where do we fit at My Wealth Planners when we have clients that retire and we want to ensure they have a safe retirement where they're not depleting their portfolio too quickly? Are we doing one of these? Are we doing all three of them? Like, what do we kind of do?
I mean, we tailor to the client, but typically what we're looking through is the lens of the retirement income style awareness map, which is from Wade Pfau. But essentially, does a client want to take a total return approach, aka essentially be super aggressive with their portfolio and to sort of acknowledge that they might need to be careful at certain periods? Do we want to take a risk wrap approach where we buy guarantees through pension, social security, annuities up to cover our necessities, and then we're very aggressive with the remainder? Do we take a bucketing approach, which I think is the worst of all worlds because it's kind of I think it's supposed to give you optionality, but it's also supposed to kind of structure things. I don't know. It feels very archaic to me compared to like modern options. Or the super duper guarantee route, do you just put all your money in annuities and pensions and just live on an income and not worry about it? Which I don't think works out well from a wealth optimization standpoint. But ironically, the research literature would suggest you'll be the happiest under that model because you feel good about spending your paycheck every month and you don't really like worry about that so much. Whereas a lot of people express higher levels of anxiety or stress around, like, gosh, what if I run out of money? Well, if all your money is guaranteed to renew every month, you don't think about that. So there's some pros and cons to all the approach, but all this to then say, part of what we do with clients is try to optimize around their preference, build a portfolio, build a retirement strategy around what version of that they're going to be the most comfortable with. Like, I know myself, and if I'm 70 today, I'm taking the total return approach, right? Like, I am at this point in my career and having managed money this long and having built wealth for myself and for my clients this long, I have learned about myself that I will not tap the brake. Like, I will just stay invested and I will ride through it and I will ignore the downturns. I won't like them, but I won't react to them. And that's something that the total return approach is great for if you have that discipline. But if you don't have that discipline, it's a terrible strategy because you'll blow yourself up. You will crash your car deliberately out of fear that you're getting out of control. So that's something where all this to answer your question, it's a question of what can the client be comfortable with and then building a strategy around that.
That makes a lot of sense to me and seems like the best way to go about it. Out of curiosity, what would you do if a client wanted to do something like one of the approaches we just discussed, like a retirement guardrails and one of those variations? Would you like just outline to them the pros and cons and then work with them to sort of go about that?
Yeah. I mean, I think that's the most important thing here is we educate a client about what's good about it. And then also talk to them about, like, here, let's just talk about the scenarios in which this is not going to work or in which we're going to have to give you bad news and talk about ahead of time, right? Hey, if we have to reduce your income, hey, if your probability of success sinks to 25%, right? Hey, if we do the 4% rule and then we go through sequence of returns risk problems where the 4% rule is not working for us, whatever it is, right? Let's educate them on the pros. Let's educate them on the cons. Let's have a thorough discussion about where this goes south or how this could go south. And then let's pick a plan and a strategy and let's stick to it. And the only time I want to change that strategy is if it's a good time to change, meaning that it's not a bad time in the markets. It's not a bad time in the portfolio. Because that's the trick, right? People always want to make changes when things are bad, and that's the worst time to make changes. And nobody wants to make a change when things are good because it's going great. So why would we make any changes?
So last topic here then. I just want to talk about, the financial planning profession. I think we've both done a little reading on like what it looked like before either of us kind of joined the industry, right? Going back to like 70s, 80s, 90s, and then like where we kind of see it going. But like I wanted to start first just like where it has been in the past and like kind of how that's led us to being here. I think like first and foremost we could talk about probably just like how it was a sales oriented industry and to a certain extent like still sort of is just by the majority of, institutions. But like how did things start out, right? Like this is a profession that is still fairly young in its, in its lifetime. If we go back to like the 70s and 80s, was it really just like stock picking back then?
Not even stock picking so much as, I mean, the early CFP conversations were largely built around like, hey, if we got better, like if I'm a tax guy but I got better at stocks, or if I'm an insurance guy and I got better at tax, or if I'm a stock guy and I got better at insurance, I could sell more stuff. I could be more of a one-stop shop. Like that was the conversation early on. And then, so they created this body of knowledge where you had tax people sharing stuff with insurance people, sharing stuff with stock people, and so on. And they used that to like be better at what they did, but all of them in the early days were still in the insurance business or the stock business or the limited partnership sales business, that sort of thing. Like a lot of early financial planning was just about like how to tactically lose money to reduce your tax bill because tax rates were so high, and so half the value was just in not paying taxes. And like that's a really weird world to think about now, where the tax code's pretty draconian about that. Like if you make money, you'll pay taxes. End of story. So I think there's an interesting early history there where originally, yeah, it was all about sales. And the idea, like it's the law, the 40 Act, the Advisors Act, that made registered investment advisors a thing, was sort of in like the back lots, like the idea of being like an investment counselor, which was the regulatory term, but like what we would now today call an investment advisor. The idea of being that was reserved for like institutional money or like family office money, like big wealthy groups. You didn't have a Daniel Stefanski working with households with 20 the then equivalent to today of like $200,000 and managing their portfolio. Like that just was not a thing at the start of the profession.
Right, and remind me, like you can write off limited partnership income against like your ordinary income, and that was sort of the deal for a lot of these like weird investments, right? Was hey, you make $100,000 a year, this thing won't make any money. It'll actually lose like $20,000, and if it gains money, great. But in the year it doesn't, you can just wipe out a portion of your income, and if you're taxed at a high enough rate, that is extremely valuable.
Yeah, I mean, the basic idea here being, and we'll just make up the numbers here for a second, so don't take us too literally, but if you were paying the upper tax bracket to like 90%, you could put your money into an investment. The investment company would spend all your money creating a business loss. You could carry that loss back onto your pay against your pay stub. And so as you said, like $100,000 a year job, suddenly you're not paying 90% tax on that, which marginal tax rates, you're not paying 90% on all of it, but just bear with me, people. Right. But let's say you were going to have a $50,000 tax bill on your $100,000 income, but suddenly if you had this equivalent $100,000 loss in this limited partnership, suddenly you don't have any income tax. And so you got to keep your whole paycheck, which felt like a pretty good return on it. And you still owned this investment. And hey, maybe this bull farm in Argentina will do well. Who knows? Like that was also the other weird thing of that era is like you had partnerships are weird, right? Like when you invest in the stock market, mutual funds, whatever, you're buying publicly traded companies, you buy bond funds, you're buying, corporate debt from Microsoft and Apple and GE. But like back in the 70s, 80s, you were buying like Argentinian bull farms or like Tibetan like dye companies and just like really weird shit, pardon my French.
So, acts are passed around the mid 80s to kind of get rid of that because I think some people kind of realize, oh, maybe that's not the best idea, and maybe we are getting some consumers getting sold some pretty nasty stuff just you know, as a way to reduce their income. So those kind of go away. And then I think the industry what sort of starts to shift toward assets under management in order to create a little bit more of a sustainable business model for the advisors because now they can generate reoccurring income, right?
Not really. I think one of the funniest things that's happened is there's this old expression about like, history doesn't repeat itself, but it rhymes. Like today, there's an army of people on the internet out there who are just like investments under management, like paying 1% AUM is a big ripoff. Nobody should do it. It's a terrible deal, blah, blah, blah. And they do all this like dumb, like algebra math to show that like it's not a good idea. because they're doing the thing where they say like results versus results minus fees, and of course the results minus fees is always going to do worse than just the pure results, as to anybody, to no one's surprise. But you bring up this, oh, they came up with like assets under management as a way to like create recurring revenue. Early on, the assets under management model was akin to taking a vow of poverty in the planning practice world, or like in the financial planning practice world. Because you had this world where, like, on one side, you can sell somebody a bull farm in Argentina or like some oil wells in Texas or whatever it is, and the financial planner, the financial advisor would get paid like a 10% commission on that. It's like, oh, you put $500,000 into this, I'm making 50 grand in a day. And that's 50 grand in 80s money. It's like 50 grand then is like 150 grand now. Like, it's crazy money. Okay. Or we can put your $500,000 into some mutual funds at like Franklin Templeton and Invesco and American funds. And oh gosh, I'm going to need you to like forward me your statements every quarter because they won't copy me on them, and there's no internet yet. And then when I get all the statements, I'm going to have to like get out a old fashioned like financial calculator and hand calculate your rate of return. And then with all of that, I'm also going to have to hand calculate your investment management bill, to then send you a bill, and you're then going to like mail me a check back. And by the way, like, none of this is automated, none of this is fast, and none of this is easy. So I'm going to work my face off compared to just selling you that oil partnership. And also, I'm going to make way less money because, by the way, I'm going to charge 1%, but I'm going to charge it quarterly. So I'm going to charge a quarter of a percent every 90-ish days. And I'm going to have to do all this work to calculate it and get it to you, blah, blah, blah. Right. So I'm going to, on your $500,000, I'm going to get paid $1,250 instead of 50 grand. Like, it was just comparatively in business model terms akin to taking a vow of poverty, which is why it took forever to get off the ground. It took literally like 25 years for AUM to start actually picking up traction in the industry.
Okay, and was somewhere along the lifetime of AUM, which we do still have today, where sort of where we live started to pick up being like fee only? Was it primarily at this point sort of like an AUM model, and people said, hey, there may be a different way to do this, and I might be interested in pursuing it, sort of thing.
Yeah, that was part of it. The charging a fee placed them originally under the auspices of being an investment advisor instead of a broker. It incurred the investment advisor's fiduciary obligation under the Advisors Act in 1940. So suddenly we're going from a, as long as it's not literally stealing your money, it's okay standard, to a, it must be in your interest with the duty of loyalty and your duty of care standard, which is a huge difference. And then, on top of that, the trick here is, you'd think the continuum would have been like, people would have gone from being brokers selling products to like, oh, maybe we'll start offering some services for a fee. So we'll be brokers who offer some fee services, will be fee based, to then being fee only. But it's actually a zigzag. You had people in the broker world only, and then you had people in the investment advisor fee only world only, because the brokers didn't want you to do stuff for fees, and they would scaremonger and tell people that they were rogue brokers, or they were like doing stuff illegally to try to scare them out of doing it or out of leaving to go do it that way. And then only 20 years later did you start seeing brokers go like, oh, now that the internet exists and computers are, and like, laptops and PCs are a little more ubiquitous, and like it's a little easier to do this, we suddenly see the perks of maybe managing money and getting a recurring fee on it instead of doing it transactionally. So we'd like to do that, but we don't want to be beholden to all the special rules. So we'll create this thing called fee based. And also, we're going to try to do that without having to be fiduciaries, which led the Financial Planning Association in the aughts, I want to say it was 2007, 2006 maybe, to end up suing the SEC to say, like, hold on a second, the brokers can't just manage money for a fee, but also do it not in their client's best interest. They have to be fiduciaries, they have to be investment advisors if they're going to do it. And they won. And that's where what's now called the Merrill Rule came from, where if you do anything with investments for a fee, you have to be an investment advisor, period. Even if you don't manage money directly, if you charge a fee and you give advice around investments, you have to be an investment advisor. You have to be a fiduciary when you do that.
Yeah, I think the thing that sticks out to me when you talk about, going from like the limited partnership deal to sort of this weird phase where it slowly shifts to sort of an AUM, but there's some hesitation because it's not as lucrative, to maybe a fee based, to maybe more popularity now and like a fee only model, is like, we can like be very glass half empty and just look at it and say, okay, well, it seems like there still is a lot of like, quote unquote like crap out there, right? And things are still, could be a lot better. But like, if I'm gonna be optimistic about it, I think the floor, meaning like the absolute worst of the worst that we continue to see, at least continues to rise. And because that floor continues to rise, I think the people actually really trying to do good work see that floor rise and now realize the degree of separation between the absolute worst and what they're doing is slightly shrunk it's marginally shrunk, so that we in turn then say, okay, I need to create more of a gap again because I don't want to be associated with them, so it almost in turn forces us to continue trying to do more and more. If I'm trying to look at a glass half full.
It's interesting. There's some really smart people. I think about like Ron Rhodes, Michael Kofikota, some people who've done like a lot of writing and a lot of sharing. Newt Rostad. Like there are groups that have tried to make the point forever. Like they've been doing it for years and decades at this point. Who've been like, look, the highest standard is fiduciary. Like to be a fiduciary and place your client's sole interest at the heart of the relationship. Like there is no higher standard. Like that's the ceiling. And yes, the floor has come up a little bit, but what's happened is the floor has come up over time. Is that the broker dealers, the wirehouses, the big names, your Wells Fargo's, your UBS's, your Northwestern Mutuals, your Edward Joneses, all these places have done a better and better and better job of co-opting the language of purity without doing it in practice. So for example, like you have, I'm just going to pick on Northwestern because I have a perfect case study from last year, and we can share it in the show notes or something. But we had a case last year where somebody was told by a Northwestern person, like, hey, we're going to do a comprehensive, holistic financial plan for you, and they did planning, giant quote marks here, okay, and then when you actually read the disclosures attached to the plan document, the reports that were given, the disclosure said this is not a financial plan. This is a sales tool in tiny text on like the 30th page. And the whole purpose of this is to demonstrate to you how and why you should buy our insurance products. And maybe after you've bought our insurance products, you should buy some of our investment products. And so lo and behold, this person ended up getting this quote unquote free financial plan that was supposedly comprehensive, holistic, and supposedly fiduciary, but obviously not, and ended up putting all their savings for a couple of years straight into a whole life policy that they did not need. That literally just burned up their savings for about 3 years. And we did this review for them last year on a pro bono basis and said, like, hey, you've just been burning money for the last 3 years. Sorry about that. They put $18,000 into it. They got like $320 back. And that is a thing where Northwestern has commercials, right, that say, like, get your free financial plan from us or your complimentary financial plan from us. They will say, like, oh, we have investment advisors here. Not all of us, but some of us. And that is normal. It is normal for these big institutions to use words like financial planning, comprehensive, holistic, to say, oh, we have fiduciary financial advice, and the a lot of the representatives can say, yes, I am a fiduciary because they're dual registered as brokers and insurance agents and also investment advisors, but they will be fiduciaries only as long as they have to be, and then we'll take that hat off. We call it the dual hat problem, and then they will then put on their broker, insurance agent, salesman hat, and will rake their clients over the coals and do it with a smile. So it's one of those things where, yes, the ceiling is there, and as you say, like the gap between like the worst and the best has gotten smaller over time, but the industry is incredibly good at using words of purity and trust signals to then sell crap to people and take advantage of them to the tune of literally billions of dollars a year.
So where do you see that going moving forward? Do you think we are able to collectively continue raising the bar, or are we kind of at a point where we've plateaued just because there's only so much more you can do? And do you see the bottoms continuing to rise, or you think it's at a point where like they're just going to keep getting away with adoption until the big companies lose enough market share that they either go out of business or have to change their ways?
I think the bottom will continue to rise only in so much as the broker dealers and the insurance companies, the wirehouses, the big institutions want it to, which means they will do stuff sort of kicking and screaming. They will do the worst that they can until they can't get away with it anymore. And then they will do whatever is necessary to rush to the next step on the ladder, right? And then suddenly they'll be in a big hurry for everybody to catch up with them, right? So I'll give an example. I will not name it this time because this is a good example of like a company doing a good thing, but I think with nefarious motivations. But they're one of the biggest companies in the country over the last couple of years. Suddenly, like overnight, in like the last 3 years, has gotten something like 40% of its several thousand financial advisor workforce CFP certified. And so, on one hand, I'm glad that there are several thousand more CFP professionals in the United States, right? Because you have to do the education, you have to take the exam, you have to have the experience. Like, there's stuff here. Where I'm like, good. I'm glad these people are smarter and better professionals now. This also has happened very suddenly over the last couple of years. And then in the last year, that same company suddenly has started offering a paid financial planning service. And I will not be surprised if they suddenly, in the next couple of years, are spontaneously on board with the industry suddenly starting to adopt some stricter requirements around the offering of financial planning on the basis that they have now moved themselves over the line and now they're okay with sort of pulling the ladder up behind them a little bit. So it's something where 5 years ago, they were literally not doing planning and they did not encourage, pay for, or support people in getting their CFP certification. And they've seen where the market's going. They've seen where public preference is going. They've seen the 110,000 articles online saying you have to hire a financial planner and that financial planner has to be a CFP. And they are suddenly in a hurry to look like CFPs who do financial planning because they think, given another 5, 10 years, they'll get left behind if they don't. So they're only doing it because the market's responding to it, not because they actually want to do it, not because it's good, not because it's something that helps them or that they wanted to do better. They're just doing it because if they don't do it, they'll get left behind. So all this to say, where do I think it's going to go? I think it'll get better. I think it's going to get better very slowly, and it's only going to get better when all the bad actor institutions have sidled up and crossed the line to whatever the next bar is going to be. And then they'll suddenly be okay with raising the bar because they're already meeting it ahead of time and only because they were ready for that bar to be raised anyway. And until they're ready for it, they will fight it in tooth and nail.
Right, well, if they're not gonna do it out of the goodness of their hearts, at least they're doing it, right?
Well, and like here's the thing, we're not alone in the world. We've seen what other countries have done. In the UK, they essentially banned selling stuff on commission. In Australia, they raised the bar crazy high, and they did it so quickly that like 90% of the industry retired or quit. So that's kind of caused its own problem. Canada has kind of shot itself in the foot. They a couple of years ago went for title protection and said like to be a financial planner and call yourself a financial planner, you have to have a CFP or a similar credential. And the shooting themselves in the foot thing here is that they then approved a bunch of credentials that are garbage to be adequate. And so like yes, you could be a CFP, but also you could be like a guy who did like a mail course over the weekend and also call yourself a financial planner. So like now it's creating this confusion where consumers think that a financial planner, anybody calling themselves a financial planner is competent, but only some of them are. It's like there's not an easy magic wand way to solve for this. And I think in the United States, more than any other country, we are very much subject to lobbyist capture, but that's sort of where things are, right? Like I want everybody to be a fiduciary and to act in their client's sole best interest. And also, the industry is not going to get there anytime soon because the industry is going to do what's in its own interest first and foremost. And it's going to be a minority's minority that does the right thing for a long time. And maybe 10, 20, 30, 40, 50 years in the future, we'll finally all be on the same playing field. But it's only going to happen if consumers stop shopping at, supporting, and buying services or products from these other companies, such that these companies recognize they have to change to stay relevant.
Would your slogan be something along the lines of like support small business, not the people who fund the football stadiums?
Yeah, I mean, not to be too mean about it, right? But if your financial product company or your financial advisor company's name is on a football stadium or a baseball field or something like that, I'm just gonna suggest that they probably make too much money for the value they provide. I'm just gonna throw that out there.
Well, that's all I had for this week then.
Well, easy enough. You know what I'm gonna ask then. What is it that you've learned in your last couple of weeks since you've been on the podcast that you think our audience would benefit from, Daniel?
It's a thing about estate planning I recently learned, which I thought was interesting. It said that like virtually in every single state, if a surviving spouse hasn't actually inherited a minimum percentage of the spouse who is now past's estate, the law, and it changes very state by state, but the law says that the surviving spouse actually has a right to a certain percentage of the deceased spouse's estate. And in some states that could be, as small as a third. In other states it could be closer to like a full half of whatever the estate was. I think in it's around half. It also gets a little tricky when you get into like how long they were married, if they had kids together, if it's a first or second marriage, etc. But I just thought that was interesting. I mean, I'm sure there are like I think the majority of folks out there would probably say, yeah, that makes sense. If I pass, I'd like my spouse to get everything. But I'm sure there's some people out there that they've been sleeping on the couch for a while, and the others they're not on the best of terms, and they don't realize the other spouse is probably entitled to something anyways.
Yeah, I mean, essentially, the bottom line here is you can't disinherit your spouse entirely. You can disinherit them a lot, but not entirely. And also, like, hey, if you're married, why don't do that, right? Like, be love each other, all of that. So I think it's good that there are some laws that protect spouses from their other half suddenly being a dick in their last days for some reason.
Probably good reason for it, yeah.
Hopefully. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.